The Philippines, once a beacon of economic promise in Southeast Asia, has long been celebrated for its dynamic workforce, vibrant cities, and a rapidly growing middle class. Over the past decade, the country experienced impressive growth rates, attracting foreign investments and fueling optimism among its people. But now, in 2025, the nation is facing a sobering reality. The once bustling shopping malls and lively business districts are showing signs of strain, with more empty storefronts and fewer customers than ever before. The nation is grappling with a significant economic slowdown, casting a shadow over its growth aspirations and impacting the lives of millions of Filipinos. Everyday citizens are feeling the pinch, vendors worry about making ends meet, and families are forced to stretch their budgets as prices of basic goods continue to climb. This slowdown, marked by a confluence of internal and external challenges, has raised concerns about the country's economic trajectory and its ability to sustain its upward momentum. Experts point to a mix of global market volatility, supply chain disruptions, and domestic policy uncertainties as key factors behind the downturn. The slowdown is evident in key economic indicators, painting a picture of faltering growth and mounting challenges. Economic data reveals a sharp decline in exports, sluggish consumer spending, and a noticeable drop in investor confidence. From dwindling gross domestic product figures to rising unemployment and persistent inflation, the effects are being felt across all sectors. Job seekers face longer waits and fewer opportunities, while inflation continues to erode the purchasing power of ordinary Filipinos. The economy is sending distress signals that, honestly, just can't be ignored. As factories slow production and small businesses struggle to survive, the nation stands at a crossroads, searching for solutions to restore hope and stability in these uncertain times. This essay delves into the 5 major pain points plaguing the Philippine economy: sluggish gross domestic product growth, rising unemployment, persistent inflation, fluctuating interest rates, and a mounting government debt. The Philippine economy, once lauded for its impressive growth rates and hailed as one of Southeast Asia's rising stars, is now facing a period of significant deceleration. For years, the country enjoyed robust expansion, attracting investors and creating new opportunities for millions. But recent data suggests that this momentum is faltering, raising concerns among economists, policymakers, and ordinary citizens alike. In 2024, the gross domestic product growth rate fell short of the government's ambitious target of 6 to 6.5%, clocking in at a concerning 5.6%. This shortfall is more than just a missed number. It signals deeper issues within the economy that could have lasting effects if not addressed promptly. The slowdown was particularly evident in the last quarter of 2024, which saw a mere 5.2% year-on-year growth. This figure, the lowest in several years, has set alarm bells ringing across the financial sector and prompted urgent discussions about the country's economic direction. Several factors have contributed to this economic deceleration. External headwinds such as global market volatility and rising interest rates have played a role. Domestically, challenges like inflation, policy uncertainty, and sluggish investment have compounded the problem, making recovery more difficult. Weakening household consumption, a cornerstone of the Philippine economy, has played a significant role. Filipino families, once confident spenders, are now tightening their belts as prices rise and job growth slows. With growth in consumer spending slowing to just 4.7%, the engine that drives the economy appears to be sputtering. If this trend continues, the Philippines may face even greater challenges ahead, making it crucial for leaders to act swiftly and decisively. This slowdown in consumer spending can be attributed to a number of factors, including rising prices, job insecurity, and a general sense of economic uncertainty. The economic slowdown has cast a long shadow over the Philippine job market, with unemployment rates climbing steadily. In February 2025, the unemployment rate reached 3.8%, a significant jump from the 3.5% recorded in the same period the previous year. This rise in unemployment is a direct consequence of the economic slowdown, as businesses grapple with reduced demand and are forced to scale down operations, leading to job losses. The most affected are those in sectors sensitive to economic fluctuations such as manufacturing, construction, and tourism. These sectors, heavily reliant on both domestic and international demand, have been hit hard by the slowdown, leading to layoffs and hiring freezes. The situation is particularly dire for low-skilled workers and recent graduates who face an increasingly competitive job market with fewer opportunities. Adding to the economic woes is the persistent issue of inflation, which continues to erode the purchasing power of Filipinos. While the Bangkosentralngpilipinas or BSP managed to keep inflation within its target range of 2 to 4% for 2024, the trend remains a concern. December 2024 saw inflation climb to 2.9%, exceeding forecasts and signaling potential inflationary pressures. Rising food and energy prices are the primary culprits driving inflation. The agricultural sector, grappling with the impacts of climate change and weather disruptions, has experienced a decline in output for 3 consecutive quarters, putting upward pressure on food prices. This is particularly worrisome in a country where a significant portion of household income is allocated to food. The Philippine government is facing a precarious balancing act as it grapples with rising inflation, a slowing economy, and the growing pressure of public expectations. Policymakers are under intense scrutiny as they try to find solutions that will both support growth and keep prices in check. The challenge is made even more difficult by global economic uncertainties, which have led to volatile markets and unpredictable capital flows. In response to these challenges and a mounting debt burden, the Bangkosentralngpilipinas, or BSP, made a significant move in December 2024 by cutting its key interest rate by 25 basis points to 5.75%. This decision was intended to stimulate economic activity, encourage businesses to invest, and make it easier for consumers to borrow money for homes, cars, and other needs. The hope is that lower interest rates will help counter the economic slowdown and provide relief to struggling sectors. However, this move is not without risks. By making borrowing cheaper, there's a possibility that demand for goods and services will rise, which could further fuel inflation and make everyday essentials even more expensive for ordinary Filipinos. The government must carefully monitor the situation to avoid triggering a new wave of price increases that could hurt the most vulnerable. Adding to the government's woes is the escalating national debt, which reached a concerning 63% of GDP by the end of 2024. This high level of debt limits the government's flexibility to respond to future crises and puts pressure on public finances. It also raises questions about how much more the government can borrow without risking the country's long-term economic stability. This rising debt, projected to reach 64% by the end of 2025, raises concerns about fiscal sustainability and the government's ability to allocate resources effectively. As the government juggles the need for economic stimulus with the imperative to keep debt under control, the coming months will be critical in determining whether the Philippines can navigate these turbulent times without compromising its future. The government is caught in a difficult position, needing to stimulate growth while also ensuring fiscal prudence. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.